Hello, it's working. Hello, everybody. Welcome back. Very impressed we got you all back after you ran off for your caffeine break. I know that we're running a little bit over time, but what happens when you get 100 economists into a room? You've got to get to the answer. So I hope that we will get to the answer about inflation with our panel today. My name is Helen Thomas. I run an independent macroeconomic consultancy called Blonde Money, and we look at how politics affects financial markets, which obviously is keeping us rather busy at present. Quite amused, of course, when you all go to the polls on Thursday in the UK election. Rishi Sunak wants you to know that he solved inflation. So no need for this panel at all, of course. Right. Well, without further ado, we have a brilliant quartet here. We have Cynthia Wu from the University of Illinois, Leonardo Melosi from University of Warwick, Egon Zakraszek from the Federal Reserve Bank of Boston, and Anna Galbao, also from University of Warwick. Now, Bloomberg Economics, I do apologize. I failed the first moderator test, which was for you to know who the people are, but you'll know a lot more about them after you've heard from them in this next hour. And we're going to have a number of slides from each person. I will be trying to keep them to time, and we will love to have your questions afterwards. But let's start, Cynthia, with your first presentation, please.
Hello. I would like to thank the organizers for inviting me, and I will focus my discussion on whether unconventional monetary or fiscal policy contribute to the inflation surge during COVID crisis. So I'll start with the aggregate results from this vector autoregression, and this is a baseline 3-variable VAR with inflation, unemployment rate, and monetary policy measures. And I have two sets of monetary policy measures, and blue is conventional monetary policy, and red captures unconventional monetary and fiscal measure. And so on the right-hand side, it's unemployment rate, left-hand side, inflation. So I normalize conventional and unconventional policy so that the response on the real activity on the right panel match each other. So the question is, how much do they affect inflation, whether it's a similar amount or different? So the key takeaway from this picture is that the inflation response to unemployment policy is smaller than its response to conventional monetary policy. And second, if we look at focus on the red line on the left panel, we could see that the effect of unconventional policy shocks on inflation is basically zero. So that's the aggregate results, and it's from the time series perspective. Now, the second set of the result, I look at some event studies, and on the left-hand side, I single out QE events. And now, because of the event study, we can focus specifically on the Great Recession and the COVID-19 period. On the right panel, I have fiscal transfer. So those are the government stimulus during those two crisis periods. And on the x-axis, I have different inflation expectation measures from the financial market, inflation swap, and the tips of different horizons. Now, the two sets of colors represents different event windows. The blue means it's a one-day window, and orange is two-day windows. Now, the key takeaway here is all the box plots are not statistically different from zero. So again, this is consistent with the story from the VAR evidence that those unconventional policy are not contributing to inflation in either direction. Now, the question is, what's the mechanism of this no result or zero result? And I'm using some of the recent study of mine to essentially trying to think about adding those QE and unconventional transfers into this small-scale 3-equation New Keynesian framework. So we can summarize those policies into the IS curve, which capture the demand side of the economy, and Phillips curve, which capture the supply side of the economy. Now, the blue terms in the square brackets are QE, and tail represents transfers. So you can see all of them together enter into both sides of the economy. And similar to the conventional wisdom that both of them enter into the IS curve in a positive sign. So essentially what that means is when there's a expansionary QE shock or transfer, they are contributing to inflation positively, which is similar to the conventional monetary policy. Now, what's different here is how they appear in the Phillips curve. Specifically, they appear with this negative sign. So what that means is essentially through the supply channel, those unconventional policy, including QE, transference, government spending too, which is not showing those equation, is disinflationary. So in aggregate, this positive effect and the negative effect cancel out in the general equilibrium. And another thing I want to highlight here, which is not apparent on those two equations, is unconventional policy work through the leverage channel in those models, which are in the micro foundation of those two equations. Now, so I emphasize that the key thing is this negative sign through the Phillips curve of how those unconventional policy affect inflation. And let's see if they show up empirically. So here I use the leverage index from the Chicago Fed to capture both sets of unconventional policy because that's what the theory suggested in the square bracket here. And the left-hand side is inflation. We use the unemployment gap to capture the real activity. So for the column I highlight in red box, essentially we see all the coefficients show up negatively and most of them are statistically significant. So this is consistent with the negative sign in my Phillips curve. Now, I further look into some more granular data to think about those questions in the state level. So with the state level, as opposed to the aggregate time series, now we can have more observations. What I have to give is that in the aggregate data, we can use this leverage index to capture both the QE and transfer events, whereas in the state level data, we obviously don't have a state differential in terms of QE and the state level leverage index. So what we do instead is we focus on transfers. There is some differential in terms of how much each state received transfers for those government stimulus packages. So if you look at the row I highlighted, you can see again in the state level Phillips curve, all the coefficients are negative, and again, most of them are statistically significant. Now, for the general equilibrium effect, all those coefficients are not statistically significant. So to summarize that, the key takeaway here are QE and transfers during COVID crisis are not contributing to inflation in either positive way or the negative way. And the key mechanism here we're showing is essentially the disinflationary effect through the Phillips curve, and I show the result through both aggregate time series and state level regressions. Thank you.
Fantastic. You crammed that all in. Excellent. I'm going to let each person speak first. Oh, hang on, Leonardo, you need the clicky thing. Because they may well comment and ask and answer some questions as they go along. Over to you, Leonardo.
Thank you. Thank you so much. So thanks. I want to thank you, the organizer, to ask me to intervene in this about this important topic, like inflation. And I'm going to discuss a little bit about the last miles and the implication of the large and growing fiscal imbalance for inflation. And I confine pretty much my attention. I confine myself pretty much on the U.S. So the first picture is the U.S. headline inflation. So it's not the first time that U.S. economy is experiencing an high period of inflation. But the earlier case, so they've been, of course, a famous period in the 1970s, but there've been another period of high inflation in the early 1950s. And of course, what is different from between if you compare the inflation in the early part of the sample and the inflation in the middle part of the sample is what is basically trend inflation. So in the 70s, what happened is inflation exhibit this ratcheting up effect, meaning that all the time inflation follows pretty much a stepwise pattern in which after every increase in inflation, the baseline inflation turns out to be higher. Okay, so every time inflation increases, the increases set a new higher. for a new baseline high for inflation. And if you look at the implication of this increasing trend inflation, one of the implications is that it took almost 20 years to bring inflation down to conquest the US inflation. What we do is to make the analysis a bit more formal. We use a model that I developed with Andrea De Pollis and Ivan Petrella, in which we basically estimate the predictive density of inflation. And these models is basically a skew T distribution, so it allows to take into account changing the balance of risk of inflation, changing the central scenario or mode, and both moments can contribute to changing trend inflation, the type of change in inflation that we saw in the 70s, and to take into and to see the contribution of each component, risk and the central scenario to the change in trend inflation. The model also allows to use study the effect of macro financial predictors on the dynamics of these moments. So here is the composition of the predicted inflation by the model, the one quarter ahead prediction of inflation in the model, which is the expected values. And this is decomposed into the central scenario or mode and the risk. And you can see that the change in the balance of risk affects inflation, but the effects are quite short-lasting, or at least they depend on the volatility of inflation. Because even if you have an increase in the risk, but the distribution of inflation shrinks because the volatility goes down, the change in risk doesn't matter much less for the dynamics of trend inflation. And so basically you can see that during the great financial crisis, the contribution of the blue part, the risk, is substantially diminished. But this doesn't mean there cannot be an issue going forward, particularly if the new normal would be the world economy dominated by high volatility, high macroeconomic volatility. So the change in the central scenario appeared to be way more persistent if you look at the mode. Again, as I showed before, the red line took like 15 years to the red line to get close to 2%. And basically, after the pandemic, you can see that the model picks two explanations for the high inflation we observed. Part is because of the increase in the risk of inflation became skewed to the upside, and the second is that the central scenario has increased. Okay, and the central scenario increased particularly in the last period because the model sees a reduction in the volatility, but inflation didn't go to the 2%, which was the pre-pandemic level, and basically that's in essence the last mile. And I want to point it out, however, that after the pandemic, if macro volatility does not subside after the pandemic, also risk becomes important. But perhaps the factor that we should most worries on here is the increase in the central scenario. The mode becomes higher, and as we saw in the previous disinflation period after the 70s. It took 15 years to the Fed. 15 years the Fed to reduce trend inflation. So the question I want to address now is, what are the economic costs of securing the last mile according to this statistical model? And here, what I show here is basically the baseline forecast of the model at the top. So that's what how the model sees the evolution of inflation in the US over the next 5 years. And you can see the struggle of the last mile in the first line. Okay, so we're not getting there if something else happens, if some news or some additional factor will intervene. So in the bottom part of the table, I do the following. I take the pattern of the first difference in the unit labor cost and the dynamics of the unemployment rate that observed during the Volcker disinflation, and I rescale it. Like I put it down so as to hit the target of inflation that you find at the bottom, so that to make sure that in 4 years, inflation will go back to 2%. And you can see that the models see, of course, a slowdown in the unemployment labor cost and an increase in the unemployment rate, which at the peak is roughly 6%. So we say probably what this model in particular suggests that probably a small or a mid recession, it may be needed to lower trend inflation and bring it back to 2%, consistent with the Fed objective. I also want to elaborate a little bit on the importance or how the fiscal imbalance may affect the dynamic of inflation, particularly long-run inflation, in a context of great uncertainty about the new normal. Okay, so a lot will depend on what is going to happen if you're going to see additional global supply shocks of large scales, as you've seen in the last 4 years. This shock poses a great challenge to inflation stabilization, particularly because in advanced economies in particular, growth rate is very low and public debt is high. So what happened with negative supply shock, they worsen the interest rate growth differential. Basically, and that implies that the fiscal adjustment are going to be larger. So if you look at the 1970s, there was a situation in which, again, you have large supply shock, high volatility, high risk, but the Fed accommodates the inflationary consequences of these inflationary shocks. So trend inflation went up, but real interest rate fell, helping faltering economic growth. So in that type of monetary policy improved the interest rate growth differential, allowing basically destabilization with minimal fiscal cost. So, of course, the effect of this will be rising long-run inflation, which is undesirable. The central question here is it possible to better coordinate monetary and fiscal policy to achieve a more balanced outcome? My view is that it's possible, but we need to realize that we have to walk a fine line between rising trend inflation and the social cost of making large and potentially recurrent fiscal adjustments. The guideline principles that we need to follow are basically twofold. One is, of course, maintaining independence and accountability of the central bank. And the second is to address the issue of long-run fiscal sustainability by introducing a credible and a clear plan of countercyclical fiscal policy that can stabilize that. I want to conclude by showing, using the same model, what happened if I compare the forecast of inflation, the baseline in orange, which is in deviation from the 2% trend. So it's basically what I show you in the upper part of the table before. And then I use a scenario that comes from the CBO. So basically, I feed my model, I condition the forecast with the CBO projection about the primary deficit to GDP, the primary deficit to debt, and the CBO projection about the cost of servicing debt going forward. And you can see that fiscal imbalances, to the extent predicted by CBO, contribute to raise inflation or trend inflation by 40, 50 basis points, which I think is a considerable number. Thank you.
Thank you. On that bombshell, raising on 50 basis points. Right. Egon, over to you.
Here. All right. Okay. I also want to thank the organizers for organizing this great conference and inviting me to participate in this great panel. I'm going to take a little bit of a policy hat. I'm going to put on my policy hat perspectives here. So I'm not going to have a model. I'm going to talk a little bit about some of the things, but I think it tails in very nicely with what Leonardo was discussing. So first, these are my own views. So God forbid you should ascribe anything of this to my boss or my bosses more generally. So like I said, I'm going to start to some themes. So I'm going to, again, focus on US. This is the world I live these days in. So has the US disinflation process stalled, right? Have we, what's the last mile? What's the impediment? And I'm going to particularly focus on two things that have gotten a lot of attention, particularly in policy circles as well as among markets, which is the so-called sticky shelter inflation, the peculiar thing that gets embedded in this, and then also about the labor markets, wages and stuff like that. Again, my take, just to give you, I said I'm going to take an optimistic view here. No, I don't think in my view it has stalled at all. I think the inflation is well on track. The disinflation process is well on track. Again, my modal outcome, to get to the 2% target. I think this progress or, slow, uneven, bumpy road is totally to be expected. I'll show you some evidence why that might be going on. And I think fundamentally what this process is underpinned is that we have anchored inflation expectations, and we do have, a restrictive stance of monetary policy in the US. But then to echo, I think what Leonardo says, there are risks aplenty, okay, and then things can go wrong. So many points that he made, I very, very much agree. So I'm just going to zero in on the picture. This is the core CPI inflation here over the few periods, and you can kind of see at the end of 2023, right? You have a lot of a lot of progress, then it kind of stalls, right? And the recent numbers looked fairly good. That's so it looks like maybe we're a little bit of a track, but there was a lot of concerns about this flattening out here about what's going on. So it's actually instructive to dig in a little bit deeper. So in this panel, I'm just going to decompose core CPI inflation into sort of its three main components. So this is core goods, this is the CPI shelter, and these are the core services excluding shelter, okay? So again, I just want to focus red line, these are sort of pre-pandemic averages. Point here is core goods, recent behavior inflation, where in fact it's in deflationary period, okay? It's sort of well below. So, that has brought inflation down. It's kind of hard to argue we're going to get a lot more downward inflationary pressure from core goods, and stuff like that. We seem to be in a sort of a pre-pandemic dynamics as it is. The two kind of components where people have been focusing out is this so-called CPI shelter. So this is the sort of a, the components of the housing, costs and stuff like that. You can see how sticky that is. It's well above its pre-pandemic average. And then also what we call core services excluding shelter. It's also quite above. An important thing here is to make is that this is, this is where labor costs matter, right? For these are services, core services. That's where, the biggest component of cost, for the firms who provide these things, is labor. So it's really fundamentally depends on the developments in labor market, particularly the growth of wages. So I'm going to focus on these two components and argue that this is actually to be expected, and I think things are on track. So, okay, what's going on with CPI shelter? So this is based on some work that my colleague Chris Cotton has just come out. I urge you to read, his papers and stuff like that. So here you have the CPI shelter in blue. You have a change in market rents, okay? And you can see that there's a bit of a phase shift, right? Market rents, have popped up, and then, CPI shelter follows. The same way market rents go down, CPI shelter follows. So there's this sort of phase shift, and that's just mechanical, okay? Market rents are the marginal rents. These are the new rents that the new tenants are getting. CPI shelter, it's a stock of rents. It's the marginal plus all the existing stuff. It takes a while to adjust the stock. That's the intuition. So what you kind of see is there's this gap, which is in the line, how much, the deviations. In equilibrium, those two things ought to be the same, okay? And they do adjust, but they adjust slowly. And what's tricky is, what's kind of interesting is that the adjustment now seems to be a bit faster than it was before, okay, Now, this is a short time period. It's kind of awkward to do econometrics on this kind of a 2 cycles. So what Chris does, he builds this stuff very nicely and exploits cross-sectional heterogeneity across MSA areas. So it's got a lot more dynamics in MSAs, as well as over time. And what he finds is that the speed of adjustment now, post-pandemic, is much faster. So this gap is closing down. What does that imply? Well, it implies that, when you have a positive shelter gap, CPI shelter just grows grows fast to close this gap, okay? And that's much more, prevalent now. And given this big gap, this is contributing a lot to this sticky CPI inflation. But as that gap diminishes, those contributions are going to wane out and you get back into equilibrium, okay? So it's got some things. There's a lot of this, but again, this is sort of over the near term. We expect, absent any further acceleration in market rents, for this process to equilibrate and we get to steady state. Wages. This chart shows sort of a couple of things. The red line is the employment cost index, year-over-year growth, and you got average hourly earnings in this light blue. Okay, you can see they kind of both remain above their pre-pandemic things, okay? So there's a lot of wage pressure. This is, again, core services, okay, this labor cost. The black line here is what we call indeed wage rate. This is the marginal wage. This is the wages, new wages for job switchers and new entrants, okay? So again, there was a lot of wage compression. These wages shot up, all right, and there's a catch-up effect that's going on, okay? So the kind of key question is if the wage growth of new hires stays at this current range, is this enough to return inflation to target, okay? Is this sufficiently enough? Well, we saw some stuff. It's going to depend both on markups and productivity, and that's the key things. You need to analyze these things jointly. So there's a really beautiful list. So let me just talk about markups here first. So the way I want to think about markups, I want to do it in terms of the labor share. Okay, so this shows the labor share in a business sector. So it's an inverse of markups. Everybody has studied this. I want you to focus on this period right here. Okay, this point here, sort of starting in 2010 and stuff like that, it seems like the markup are stable or the labor share has been stable. It's very low by historical standards. So the question is, can this labor share returns back? Are firms willing to accept lower markups, sort of pre-pandemic level of markups, okay? That's going to be the crucial dynamics. Now, again, it's tricky to be doing econometrics on this limited, time series of the data, but you can get a lot more power if you employ some industry, variations across industries, okay? So a couple of my colleagues have so my friends, a couple of my colleagues have a very nice, a piece here in a current policy perspective that analyzes this from the industry level perspective. And what they show is that, provided, that you accept that this is a steady level of markups, okay, this adjustment can happen, okay, even if productivity growth stays above its pre-pandemic level, okay? And the dynamics are very straightforward. You're going to have a bit of a high inflation, wages grow above, about 3%, so higher than you expect. We're consistent with a 2% inflation target. But then what it is the firms are just willing to accept lower markups, which is more likely as the demand moderates, okay? So that would be without making any assumptions about faster productivity growth. Now, if you think about AI and some increases in productivity, labor productivity that we've seen in the US, is this temporary? Is this a level shift? Is this a trend growth? Anything on a positive that makes that adjustment process a lot faster and a lot easier. That's it. Thank you.
Great. Thank you again. Anna's going to move us into the world of financial markets, I believe.
Hey, thank you for the organizers for bringing me here for this debate about inflation. So I want to go over, these are my views and our views of Bloomberg. So I'm going to talk to you about the impact the inflation had on financial markets. To do so, I'm just going to start showing this. It's just a quick slide telling how I measure that effect. So the idea here is that one way that inflation affects financial markets, one of the main ways, is by extracting news from information on the data is released. So I'm going to we have something that's called the surprise, which is the difference between the data being released, and there are many inflation data being released for the US, for the UK, for the euro area every month, and the survey done by Bloomberg that's done a few days before the release of the data. And what I tried to do to measure the effect of this data or this new information on financial markets is to build inflation surprise index. So I built 3 different inflation surprise indexes, one for the US, one for the UK, one for the euro area. The US has 33 data events, UK has fewer, and the euro area has 44. Euro area has a lot because you look at the events not only for the euro area data, but also for the 4 major countries. And also the euro area has loads of data releases that goes preliminary and final estimates. And the idea of using all this data is to come up, as I told you, these surprise indexes, which is a way to measure what market participants have learned about data release in the last few months. So this is basically the initial step to try to understand, how inflation data and how this high inflation period would have affect financial markets. So I don't know if you can see this. So I think my black lines are looking terrible in this light. I should have put them in white. Actually, they're looking really bad. So I don't think you see much, but there are three indexes in there. Has one for the euro area, one for the UK, one for the US. You can see that they are starting 2000. They kind of move together. And you can see that they peak a lot on that part here. So this is after 2020. You see some periods that they diverge. So this is a diversion between UK and the US and the euro area, but they kind of move like that over time. And all my slides are going to be black, so they all look bad. So basically, this is for the most recent period. And basically what you see is that the forecasters start missing first, actually forecast for US inflation. So this line here that I'm putting the red bit is the US. And then they start missing for the euro area. The euro area peaks a bit late in 2022. And then fun enough, everyone now in the beginning of this year were in the negative side. So in my index, what that thing means is that you start having more downside surprises to inflation. So the inflation was being published lower than expected by the market by the beginning of this year. But now the US in particular has reverted a bit. You start having loads of upside inflation surprises again. The UK has been a bit, and the euro area last week basically went in line with consensus. Okay, so basically I'm going to use this series to try to measure the impact that all this variation in terms of new information coming from inflation affects financial markets. So the way we did it is that I add these surprise indexes in a fine model of the term structure of interest rates. And basically what you see here is maturities in years, and this is a variance decomposition. So basically what it tells you that across maturities, you have up to 20% of the variation of treasuries. This is this sign. And the other side here, German bonds, so bonds or the euro area benchmark, if you want it, explaining by the variation of surprise indexes. And I have also a growth surprise indexes. So here I can contrast them, and you can see that inflation surprise explain about 10% here in the US. And for Germany is actually smaller, but this is an average over time. So if you look over time, you would find much bigger deviations, in particular for the most recent period when you have these very large inflation surprises. Other thing we use this recently at Bloomberg is that since I have this model that allows me to see the impact of not only the effects of the surprise index, but also specific inflation events, we measure basically how much the data release of different euro area data has in terms of changing the risk-free rate in the model. Okay, and these yellow bars here, at least the yellow bars you can see, are basically for Spain, Germany, France, Italy, and the cores. And these are all preliminary releases, so the ones that are being released either today or released last week. And basically what we found out that was basically the surprises of the French inflation that were having, so this is the effect of 0.2 surprises having a strong effect. And the reason why we found that is that somehow, and this is basically what these triangular things are, is the consensus gets right French inflation more frequently for the other countries, which means that if there is any, if a deviation of 0.2 is actually very sizable and explains some of these effects. And also there is also the fact that in the model, French data is published a bit earlier in Euro as these other countries. Okay, so we could use the model to figure out basically impact of specific data releases over time. This is one of the decompositions. This is for the UK. So basically we try to see how important the surprises were for the risk-free rate for the UK. So the risk-free rate is the Y line. And basically what you see is that the blue bars here is basically the contribution of the surprises over time. During the period that you have these positive inflation surprises, the surprises were raising the risk-free rate, and now more recently, they are actually having negative effect on it. Finally, we also look at the impact that that has on bond risk premium. So this is an example for the US. And basically what you see is that that positive inflation surprises have been rising the risk, the term premium on the 10-year bonds. Basically, you see this white bar here in 2022, 2024. And basically, you can see this is about 50, 60 basis points deviation is the highest over all the samples. So if I start from 2000, you're going to see the earlier, the impact used to be much smaller, and you have a bigger impact now. So this kind of tells you that inflation matters a lot for financial markets. And it's not only at the day the inflation is released, but also you can see that my effects here are kind of persistent over time, because they normally help to predict how monetary policy is going to do. So over time, you find these persistent effects. So just summarizing my views, I think as long as monetary policy has a key effect on financial markets, and we saw earlier today in the first session, the global financial cycle, how that's related with monetary policy. So this is very much in line on that. Then release of inflation data or the surprise from inflation data would have a big impact on financial markets, not only at the time of the release, but also over time. I'm currently working on seeing the impact of this on exchange rates. Again, as we discussed this morning, you can see big effects on financial markets. And finally, we have something at Bloomberg, which is sentiment index in terms of Fed speak. And you can see that that index is also related with both the inflation, is this last plot here is more I have in the corner, with both inflation and growth surprises. So one other channel that this propagates in terms of effects on financial markets is that, you know, the communication of the data or the new surprises coming from the data goes to the Fed official speaks. And of course, we know as well that the Fed official speaks do have an impact on financial markets, and probably going to have more now that we have all these high frequency index, so they can directly work based on it. So these are my views in terms of how important inflation is for financial markets.
Anyway, okay, wow. Full whistle stop tour through inflation. That's incredible. I'm going to ask the audience question first, though, which is we've had a brief debate about whether the US inflation rate has stalled. We've heard a couple of things here. Keep on making case. Leonardo, though, you looked at your CBO estimate could add to inflation, right? That was the scenario. So I'm going to ask all of you, put your hand up. I'm not going to take your name, don't worry. Will US inflation hit target on the headline measure in the next couple of years? Everybody thinks it will. Hands up. A lot of people. And everybody thinks it will not. It has stalled.
Everyone really
I feel like, yeah, it's pretty strongly on.
That is doing a good job.
Okay. Well, my question then, Egon, actually is it possible from your model to know how long we have to wait to see this faster effect? Because you make a very persuasive case, but does your data show you anything on that?
Yeah, it does actually. So, I mean, again, this is all, you know, it's assuming we don't have any other surprises, which, you know, that could certainly be it. But the shelter thing is sort of effects will be felt through, it will be making sort of meaningful contributions, still sort of supporting shelter inflation, you know, to roughly sort of early next year, you know, after you know, January, February, or sort of next year, the effects, you know, should, you know, work themselves through. That will be sort of, you know, again, if you do not have a re-acceleration in market rents and stuff like that. The wages, I think the wages there, it's you know, there's maybe it's less of a mechanical, in some sense, less of a mechanical thing. It will obviously depends on, you know, how willing, you know, our firms to absorb a return to markups to sort of a more natural, you know, more sort of pre-pandemic type of level. And that's, right now we know firms have been, I mean, they don't want to do that, obviously, but, you know, they didn't have to. Economy has been going, you know, very strongly and stuff like that. But, you know, if you've been following latest numbers, it looks like, you know, there is monetary policies working through. Interest-sensitive components of demand have slowed. We may be somewhere, you know, at or maybe slightly below trend growth, particularly if you think the trend growth has been higher because of immigration and all of these other things that are US-specific factors. So in that kind of environment, firms have less, you know, have less power to maintain the higher markups. So we could see that stuff like that. And then the other thing is going to be, you know, what's going on with the productivity, labor productivity. We've seen it's a huge question. We've seen, particularly in services, a really significant step up in measured labor productivity. I mean, these numbers are noisy. They get revised, right? We all know that they're tricky. You know, but, you know, if productivity improvements are sustained, certainly over the, you know, kind of a near term, that would really help the adjustment process. But even if they don't, you know, with a little bit of a cool down economy, kind of slightly below trend growth, you know, this should sort of work its way out, you know, through kind of middle of next year and roughly. So that's the horizon we're talking about.
Very quick comment. I think it will be interesting to compare the dynamics in the US economy and the UK economy, where the economy is slightly weaker.
Yeah.
So maybe harder for firms to protect the market.
That's right. Yeah.
And yeah, so that's all. That's a little interesting.
interesting to see that there's now something of a divergence this year on the surprises. You draw any conclusion about, well, this may be an unfair question. Has the Bank of England done a better job than the Fed, or vice versa, on anchoring inflation expectations?
I think the way I think this is that, as I said before, right? Some of these surprises are really very hard to predict. There were some periods in which global factors explain why they move together. So for example, there was a period in which all the countries have negative surprises, which means they forecast a rate that was far too high because they didn't predict correct impact of declining oil prices. So there are things like that make people miss inflation together, and you could clearly see from our plot that happens. I think it was very surprising seeing the upside surprises on inflation for the US picking up this year in contrast with both the euro area and the UK. But I'm not sure if that means that the Bank of England did a better job than the Fed in controlling inflation. But it's very bad news for the Fed that happened.
Can I pick up very quickly on the financial review for and a comment there on, well, it doesn't seem very happy with fan charts. You think it's good to get rid of them? Does that help communication?
I spent many years in academia doing econometrics and teaching students how important were fan charts to convey uncertainty. So it's very frustrated. At the same time, I understand that. So one of the issues the fan chart had is that over the years was used to communicate sometimes the disagreement of the committee. So if you look like the most recent upside risks to inflation, they're very much related with the fact that the committee was voting always with a number of dissents in terms of people that wouldn't agree with the view of raising rates or keeping rates. So, and of course, you don't know a lot of the causality, right? So it's because people have different views about inflation, they take different views about the policy decision, but there was clearly a relation there. But that's not what fan chart's supposed to do, right? It's supposed to tell you how uncertain you are about the future for inflation. So Bernanke suggests to use scenarios, and there's other central banks doing that now. So you could have a scenario, I don't know, if higher risk, lower risk. But I think that's something that's very important, and this is a question for all of us, is that when we communicate uncertainty, it's very important that we're able to assign probabilities for some of these events. And this was a great thing about the fan chart, although there were some time a bit disguised there and some people found difficult to understand. But I think it's very important that we do so. And some of the scenario communication, sometimes central banks design scenarios, but they don't attribute probabilities to that. And I think it's important that that somehow is kept.
Yeah, probabilities are not always linear.
Yeah.
But they still help to create a framework. Yeah. Cynthia, you want to comment anything before I go out to the things? No? Oh, yeah.
Can I say a quick thing about the last mile?
Yeah.
So one danger of talking about the last mile is that we don't have to forget risk. So last mile, the fact that we are not securing the last mile in timely manner is a vulnerability. If no shock will happen, you can get back to the ratcheting up effect I was discussing about for the 70s. So inflation will increase, and after every increase will set at a higher level. And that's really the reason. So it's good to talk about the last mile, the challenge, but no, these are all discussions somehow based on what we know now and a deterministic environment, how the model converge. Also my analysis was like that. But we also need to think about, a little bit better about, to make this exercise in a stochastic environment in which risk matters. That's the only thing I wanted to say about the last mile as well, because it was a bit. And that's
a nautical mile.
The extra mile.
Sorry, I've asked lots of questions, and I know. Yeah, okay, on time. We've got about 15 minutes. So does anyone want to jump in? Sorry, we have roving mics. Oh, yeah, okay. Oh.
Martin Wheel from King's College, and this is a question for Cynthia, please. Well, first of all, I should say thank you all for fascinating presentations. But the work you did on differential performance, of the transfers in states, how far is, I can see that if you have a heterogeneous population, that will affect the amount of transfers that they get, but won't it also affect the way that people might respond to transfers? And wouldn't you want state-specific effects to take account of that?
Are you asking how far? What am my sample focusing on, or are you asking? Can you repeat your question?
Well, I suppose I'm asking whether you had state-specific effects which reflected the heterogeneity of the responses in the states, as well as the possible as well as the heterogeneity in the amounts received.
So you're saying if I have control to some state-specific effects, and we have. Yeah, yeah.
The gentleman down here at the front. You can say who you are, where you're from.
Yeah, I'm Lan Roy from LCP and LSE. Fascinating session. First of all, I'd like to compliment Cynthia because her results tie in with a lot of what St. Louis fed and my discussions with former Governor Clarida worked a couple of weeks ago. But my question is to do with Leo and also with Egon. To what extent do you think labor productivity, R-star, et cetera, figures? Because there are links out there between how we influence policy, inflation expectations, et cetera. So that's my question to two of you or the rest of the panel.
Sure, no, it's a relevant point. I think there are two things right now, right? In my view, is that what we're seeing in terms of just labor productivity is I think we're seeing just a more of a level shift. I think it's very early to talk about a permanent shift in a growth rate of this. Now it's possible, but I think the AI type of things I've seen, it's still very early to tell that this is sort of showing up in labor productivity at the aggregate level. But again, I think the jury is going to be out. To your point on R-star, yeah, I think it's related, obviously, a question to that. I think it's I was just pointing to the latest dot plot, which, the infamous dot plot that just came out for the summary of economic projections. Their policymakers have revised up their long run estimates of the federal funds rate. If you read the commentary around there and stuff like that, they have been pointing out to potential things that's going on. So that has obviously implications for the restrictiveness of monetary policy, right? And stuff like that. But yeah, this right now, there's just, again, a huge amount of uncertainty around there. And it's going to be it's why I think Fed is stressing data dependency as much as it does.
I have not much to add. I stress that both labor productivity and R-star are very hard to estimate. I mean, R-star, we have very, broad set of numbers that our model find consistent with the current data. So this is a warning to not over-rely on R-star when you take monetary policy decisions.
Thank you. So two questions. So one is, how would you define exactly, what the last mile problem is? Because you hear about it a lot, but I have a bit of difficulty understanding what it really means. And so one thing that puzzled me is also that people say, okay, we had high inflation, and people shift inflation expectations. So what I find difficult to believe is that on the one hand, we had double-digit inflation, but then people seem to be supposed to adjust inflation by decimals. So for example, we had inflation about 10%, and according to this view, people now see inflation rather than be 1.8 to be 2.2. And I just don't find this behavior plausible. So if you really lose, faith in the central banks and so on, then you bring inflation to 5% or 10%, not to 2.2. So this mechanism doesn't strike me as plausible. And that's question number one. Question number two is, I've seen recently Larry Summers and co-authors have looked at inflation where you actually include mortgage rates. And actually, when you do that, inflation is much higher and is as high as in the 70s. And that, of course, also means that inflation perception is also high. So how do you see that? Because now we exclude the mortgage rates from inflation, but in the past we used to include them. And and this is interesting because it creates a bit of a kind of counterproductive way in which monetary policy acts. Of course, monetary policy, raises mortgage rates and raises perceived inflation. So, do you think that is an important factor also?
So, I agree. I think the last mile is it's obviously a bit of a tricky issue. I think probably pragmatically, the way you want to think about it is, we've seen, a fairly rapid progress of bringing inflation down from its peak, and last year was really remarkable, right? We had, booming labor market, inflation came down, and then this year, it just stalled, right? So it stalled at a sort of 3%, somewhere in that range. And that's partly because, there's, if you sort of dig in, it's now concentrated in very sticky components. And those things just take a long time to adjust. And I think the kind of dynamics that then people worry about, and I think you've alluded to them in this, is that, Fed is saying it's 2%, but this thing begins to hover around, 3% and 3%. Well, then eventually expectations adjust, it gets embedded, it gets ingrained, and becomes harder and harder. I think that's kind of where they, that's sort of what the thing it is. The point that I was trying to make is, and, I've seen some past colleagues, this is, if you actually go to micro level CPI data at the item level, sort of the true goods level, so it's like millions and millions of goods, and you re-aggregate inflation based on the frequency of price adjustment, it's all coming from these super sticky things that reset very, very, very slowly. It just takes time to, work itself out. And then, to your point, I wasn't quite sure about mortgage rates. I'm not familiar. I mean, well, it's. I mean, to the extent that this is through the owner, equivalent rent, and to these shelter components, that those costs are in there. Whether or not they're fully reflected, I'm not sure. But we could talk offline. You can tell me this stuff. But Anna, you know.
No, it's fine.
5 minutes.
Hi, really interesting panel. Thanks very much. I guess this is mainly a question for Leo. I'm not sure if Egon's allowed to answer it, but I was going to ask about monetary policy frameworks. I think frameworks, in some sense, are a response to some of your concerns about these fiscal merger interactions and the sort of Leaper-esque, risks. Maybe you could talk a bit about, or can you talk a bit about maybe the impact of the Fed's flexible average inflation targeting, sort of some of the ECB changes in their frameworks. Is that enough? Has it gone the wrong direction? What do we need to see maybe in terms of frameworks to guard against the sort of fiscal issues you were concerned about?
In terms of the monetary policy framework, I mean, for example, there have been different way in which central banks have revised the framework. For example, ECB moved to a symmetric target. I don't expect major revision to that framework based on the most recent events. The Fed in the statement of long run goals as more like an example on this flexible inflation target. They say something like, inflation been low for so long. Now we want to allow for inflation. We are okay with inflation to overshoot. Somehow I'm rephrasing it, but the word, it was like an example. It was not really, they never mentioned ever inflation targeting, whether it's symmetric, asymmetric, hopefully it's asymmetric. So there may be some clarification may be needed, but in terms of fiscal and monetary policy interaction or the challenges coming from these interactions, I stress the fact that the lots will depend on what is going to be the new normal. If we're going to live in a world that will be dominated by large supply shocks, we will need also some investment in the fiscal framework or some change in the fiscal framework. And because fiscal adjustment are going to be very hard to avoid if you want to keep inflation stable. That's basically what comes from the model you mentioned, Leaper, and more recent studies on the topic. Again, these are theoretical models, so we need to be taken with a pinch of salt. But these are our standard models using central bank. They are the Keynesian model, and so we need to if you like the prediction on the one end, we also on the particular side we also like the prediction also when it's telling us something about potential fiscal risk for inflation. And from this point of view, I think again it depends very much about whether we're going to see recurring global supply shock, like what's going to happen to the geopolitical risks, because those shocks, unlike demand shock, will make R minus G positive, right? If you follow fiscal dominance, and so the fiscal authority needs to make a fiscal adjustment in this case. If you take the 1970 route, then monetary policy accommodated largely this shock and create inflation, then you improve R minus G, you make it lower, and then you can basically stabilize debt to GDP ratio without major fiscal adjustment. That's what basically pretty much what happened in the 70s, where debt to GDP ratio fell dramatically, but inflation was so high, and trend inflation was high. It didn't happen. It happened in a stepwise way. So shock happened, inflation kept increasing. So that's it.
I think it was just this, just this week. But
No.
but yeah, no, it's interesting. Yeah.
But any country right now could be from the Jubilee. Not very long. Get our whole handle on that. Okay, any final questions? Lunch is beckoning. Right, well, I think I'll draw to a close. I'd like you all to thank the panel. You've been excellent, and thank you for listening.